If you take a train to the quiet industrial city of Basel, Switzerland, and walk towards the central station, you will see a building that looks out of place. It is a brutalist, cylinder-shaped skyscraper that rises 230 feet into the air, looking remarkably like a nuclear cooling tower. This is the headquarters of the Bank for International Settlements, BIS. It is the most exclusive club in the world. Its members are not people, they are central banks. The Federal Reserve, the ECB, the Bank of Japan, and the People's Bank of China all send their governors here for secret meetings every 2 months. The building sits on soil that is technically not part of Switzerland. It has the same legal status as an embassy. It has its own police force. Its documents are inviolable. No judge in the world can demand to see them. And its officials have diplomatic immunity. It is, for all intents and purposes, a sovereign state dedicated to the rule of money. And inside this tower, in a series of wood-paneled conference rooms, a committee of unelected technocrats writes the code that runs the global banking system. These are the Basel Accords. They are the invisible laws that determine how much money a bank can lend, how much risk it can take, and ultimately, whether the global economy booms or busts. To understand why your mortgage application was denied, or why the 2008 crisis happened, you don't need to look at Wall Street. You need to look at the Tower of Basel. The story of the Basel Accords begins with a failure. In 1974, a German bank called Bankhaus Herstatt collapsed. It was a chaotic, messy failure that happened in the middle of the trading day. Because of the time zone difference, Herstatt took payments from American banks in the morning but closed its doors before it could pay them back in the afternoon. The money effectively vanished. The global banking system seized up. The central bankers of the G10 nations realized that banking had become global, but regulation was still local. A German bank failure could hurt American banks. There was no hotline, no standard, no rules of the road. So they formed a committee, the Basel Committee on Banking Supervision, BCBS. Their mandate was simple: create a global standard to ensure that banks have enough of a safety net to survive a crash. For the first decade, they argued and debated. But in 1988, they finally released their first masterpiece, Basel FIR. It was a document of only 30 pages, but it changed the world. The core idea of Basel FIR was the capital adequacy ratio. The committee decided that every bank in the world should hold capital equal to at least 8% of its assets. If a bank lent out $100, it needed to have $8 of its own equity in the vault to absorb losses. It sounded simple, it sounded prudent, but the devil was in the details. The committee introduced a concept called risk-weighted assets, RWA. They realized that not all loans are the same. A loan to the US government is safer than a loan to a startup company. So they created buckets. They assigned weights to different assets. Government debt was given a 0% weight. That meant it was considered risk-free. A bank didn't need to hold any capital against government bonds. Residential mortgages were given a 50% weight. Corporate loans were given a 100% weight. This simple math equation fundamentally rigged the global economy. By giving government debt a 0% weighting, the Basel Committee effectively told every bank in the world, if you lend to the government, it's free. If you lend to a business, it's expensive. This created an insatiable demand for sovereign debt. It allowed governments to run massive deficits because banks were eager to buy their bonds to pad their balance sheets with risk-free assets. It also encouraged the housing boom. Because mortgages required only half as much capital as business loans, banks aggressively shifted their portfolios toward real estate. The Basel I rules didn't just regulate the market, they distorted it. They incentivized banks to stop funding productive industry and start funding government bureaucracy and housing bubbles. But banks are clever. They looked at the Basel I rules and found a loophole. The rules said that corporate loans required 8% capital. But if the bank sold the loan to someone else, they didn't need any capital. This birthed the modern era of securitization. Banks realized they could originate a loan, package it into a bond, and sell it off their balance sheet. By doing this, they could technically reduce their risk-weighted assets and lend more. This was the seed of the 2008 crisis. The originate-to-distribute model, where banks didn't care about the quality of the loan because they weren't keeping it, was directly encouraged by the Basel capital rules. The banks were just trying to optimize their regulatory math. By the late 1990s, everyone realized that Basel I was too crude. It was a blunt instrument. So the committee went back to the drawing board in the tower. They spent years crafting a sequel. In 2004, they released Basel II. If Basel I was a pamphlet, Basel II was a phone book. It was hundreds of pages of complex formulas. The goal was to make the risk weighting more scientific. Instead of just saying all corporate loans are 100%, they decided to rely on credit ratings. If a company was rated AOA by Moody's or S&P, the bank needed less capital. If it was rated B, it needed more. This outsourced the safety of the global banking system to 3 private rating agencies in New York. We all know how that ended. But Basel II made an even bigger mistake. It introduced the internal ratings-based IRB approach. This was a concession to the big banks. The giants, like JP Morgan and Deutsche Bank, argued that they were sophisticated enough to build their own computer models to calculate risk. They said, "Trust us, our math is better than your rules." The Basel Committee agreed. They allowed the biggest banks to use their own internal models to determine how much capital they needed. This was, in hindsight, insanity. It was letting the students grade their own exams. Unsurprisingly, the bank's internal models always came to the same conclusion. We are super safe and we don't need much capital. The banks use these models to shrink their capital buffers to razor-thin margins. They optimized their balance sheets for maximum profit, assuming that their value-at-risk models were perfect. The Basel II rules were fully implemented in Europe just in time for the 2008 crash. In fact, many European banks were following Basel II rules when they loaded up on American subprime mortgage bonds. Why? Because the rating agencies had stamped them into AAA. Under the Basel II rules, a A-rated mortgage bond had a very low risk weight. It was capital efficient. A bank could hold billions of dollars of toxic subprime sludge and tell the regulators, "Look, according to the Basel rules, we are perfectly capitalized." The rules didn't prevent the accumulation of risk. They hid it. They gave a scientific veneer to a massive gamble. When the housing market turned, the AAA ratings evaporated. The internal models broke, and the banks realized they had almost no actual equity to absorb the losses. The system that was designed to prevent a crash had acted as a camouflage for the bomb. The collapse of 2008 was a direct indictment of the technocrats in the tower. Their risk weights were wrong. Their reliance on credit ratings was disastrous. And their trust in internal models was naive. But in the aftermath of the crisis, the response wasn't to scrap the system, it was to double down. The regulators argued that the problem wasn't the concept of global rules, but that the rules weren't strict enough. They convened again in Basel. The mood was grim. The world economy was burning. And from the ashes of the crisis, they began to draft the third installment of the trilogy, Basel III. This time, they promised, there would be no loopholes. This time, they would make the banks bulletproof. But in their zeal to fix the last war, they may have created the conditions for the next one. The rollout of Basel III was not a negotiation. It was an imposition. In the wake of the 2008 crisis, the central bankers in the Tower of Basel had lost their patience with the unself-regulation of Wall Street. They decided to build a regulatory cage so strong that no bank could ever escape it. The new rules, finalized in 2010 and slowly implemented over the next decade, were designed to turn banks from risk-taking casinos into boring, utility-like fortresses. They increased the amount of capital banks had to hold. They introduced a leverage ratio, a hard cap on how much debt a bank could take on, regardless of what the risk model said. But the most transformative and controversial part of Basel III was a new rule called the Liquidity Coverage Ratio, LCR. The LCR was born from the trauma of Lehman Brothers. The regulators realized that Lehman didn't die because it ran out of assets. It died because it ran out of cash. It faced a run, and it couldn't convert its mortgage bonds into money fast enough to pay the bills. So, the Basel Committee created a rule. Every bank must hold enough high-quality liquid assets, HQLA, to survive a massive stress scenario lasting 30 days. In plain English, banks were forced to keep a massive emergency fund of cash and easy-to-sell bonds sitting in the vault, doing nothing, just in case the world ended. On the surface, this sounds like common sense. Who wouldn't want banks to have an emergency fund? But in the world of finance, there is no such thing as a free lunch. The LCR fundamentally changed the business model of banking. It redefined what an asset was. Under the new rules, the best asset a bank could own was government debt, U.S. Treasuries, German bunds. These were considered level 1 assets, perfectly liquid, perfectly safe. On the other hand, loans to small businesses, trade finance for shipping, or lines of credit to corporations were considered illiquid. They were penalized. The result was a massive behavioral shift. Banks stopped acting like engines of economic growth and started acting like storage lockers for government debt. Since 2010, the banking systems of the US and Europe have aggressively increased their holdings of sovereign bonds while their lending to the real economy has stagnated. This created the dreaded doom loop. The Basel rules tied the fate of the banks even tighter to the fate of the government. By forcing banks to buy government debt to satisfy the LCR, the regulators made it so that if a government ever defaulted, or if bond yields spiked, crashing the price, the entire banking system would be insolvent. We saw a preview of this in the 2023 collapse of Silicon Valley Bank. SVB failed exactly because it followed the Basel playbook. It bought safe government bonds. But when interest rates rose, the value of those bonds crashed. The rules that were supposed to make the bank safe were the very thing that killed it. But the most insidious impact of Basel III was on the plumbing of the financial markets. In their zeal to make banks safer, the regulators made them rigid. They stripped away the flexibility that is needed in a crisis. This became terrifyingly clear on September 17, 2019, during the repo spike. The repo market is where banks lend cash to each other overnight. It is the oil that keeps the engine running. On that Tuesday, for complex reasons, the demand for cash spiked. In the old days, a giant bank like JP Chase, which was sitting on hundreds of billions of dollars in cash reserves, would have stepped in. They would have lent the cash, pocketed a profit, and calmed the market. It's what banks do. But on that day, JP sat on its hands. Jamie Dimon, the CEO, later explained why. He said that while the bank had the cash, it couldn't lend the cash because of the liquidity coverage ratio. If they lent the cash out, their LCR number would drop below the regulatory minimum, and the supervisors in the Tower of Basel in Washington would come down on them like a ton of bricks. The regulation acted like a straitjacket. It forced the bank to hoard liquidity right at the moment the market needed it most. The result was a breakdown in the financial system that forced the Federal Reserve to intervene with hundreds of billions of dollars. Basel III had created a safety paradox. By making individual banks safer, it made the system more fragile because it removed the shock absorbers. This rigidity also filtered down to Main Street, creating the computer says no era of lending. Under Basel III, the cost of compliance skyrocketed. Every loan had to be justified, risk-weighted, and reported. For a bank, it became unprofitable to lend $50,000 to a local bakery. The regulatory cost of processing that small loan was almost the same as processing a $50 million loan to a giant corporation, but the capital charge was higher because the bakery didn't have a credit rating. So banks retreated. They stopped lending to small and medium-sized enterprises, SMEs. They closed local branches. They focused on wealth management and trading, where the margins were higher and the Basel math was friendlier. The zombification of the economy, the slow growth, the lack of dynamism, is partly a result of these secret rules. The capital is trapped in the fortress, guarding against a crisis that happened 10 years ago, instead of being deployed to build the future. Furthermore, Basel III solidified the dominance of the global systemically important banks, GSIBs. The rules are so complex and the compliance costs so high that only the massive giants, JP Morgan, Citi, HSBC, can afford to follow them. Small community banks are being crushed under the weight of the paperwork. This has led to massive consolidation. The too-big-to-fail banks have become even bigger, effectively functioning as regulated utilities protected by a moat of red tape. The Basel Committee, in trying to restrain the giants, inadvertently killed their competition. But the technocrats in Basel are not done. Even as the banks struggle to digest Basel III, the committee is putting the finishing touches on what the industry calls Basel IV, though the regulators insist on calling it Basel III Endgame. This final update is an assault on the internal models that allowed European banks to game the system. The regulators want to institute an output floor, a rule that says, we don't care what your fancy computer model says. You cannot hold less than 72.5% of the capital required by the standard formula. The European banks are screaming. They argue that this will increase their capital requirements by billions, forcing them to cut lending even further. The Americans are pushing for it. It is a transatlantic tug of war, fought with spreadsheets that will determine the lending capacity of the Western world for the next decade. The Basel Accords operate on a fundamental arrogance, the belief that risk can be measured, categorized, and managed by a committee. They assume that the next crisis will look like the last one. They built a Maginot Line against mortgage defaults, but the next war might be a cyber attack, or a pandemic, or a sovereign debt crisis. By forcing all banks to follow the same strategy, buy government bonds, hoard cash, avoid risky business loans, Basel III has created a monoculture. In biology, a monoculture is vulnerable to disease. If one stalk of corn gets sick, the whole field dies. In finance, if all banks hold the same safe assets, and those assets suddenly become unsafe, like treasuries in 2022-2023, then all banks get sick at the same time. This herd behavior, mandated by law, is the ultimate systemic risk. As we look at the banking landscape today, it appears calm. Capital ratios are high, the fortresses are built, but outside the walls, a new threat is growing. Because the banks have stopped lending to risky borrowers, the demand for credit didn't disappear, it just moved. It moved to the shadows, it moved to private credit funds, to fintech lenders, and to the unregulated corners of the market where the Basel rules do not apply. The Tower of Basel may have tamed the banks, but in doing so, it may have simply pushed the risk into the dark, where it is growing unseen, unmeasured, and uncontrolled. The supreme irony of the Basel Accords is that in their attempt to make the banking system fail-safe, they simply moved the failure to a place where they can't see it. By making it expensive for traditional banks, like Wells Fargo or Deutsche Bank, to lend to actual businesses, the regulators created a vacuum. And in finance, a vacuum is always filled. This birthed the boom in private credit and shadow banking. Today, if a mid-sized software company or construction firm needs a loan, they often don't go to a bank. They go to a private equity giant like Blackstone, Apollo, or KKR. These firms are not banks. They don't take deposits from grandmothers. Therefore, they are not subject to the Basel rules. They don't have to hold the same capital buffers. They don't have a liquidity coverage ratio. They can take risks that the regulated banks can't touch. This has created a two-tier financial system. Tier 1 is the clean system, the regulated banks that hold all the government debt and process payments, but do very little actual risky lending. Tier 2 is the shadow system, the unregulated funds that actually drive the economy. The risk hasn't disappeared. It has just migrated from the balance sheets of banks, which the government guarantees, to the balance sheets of private funds, which theoretically they don't. But here's the terrifying question. If a massive private credit fund collapses, will the government really let it burn? Oh, have we just created a new class of too-big-to-fail institutions that are entirely outside the control of the Tower of Basel? The regulators are playing a game of whack-a-mole. They hammered the banks, and the risk popped up in the shadow sector. They are now talking about regulating the non-banks, but the market moves faster than the committee. But the most dangerous flaw in the Basel architecture isn't about shadow banks, it's about the foundation itself. The entire system is built on the premise that sovereign debt is risk-free. The Basel rules assign a 0% risk weight to the debt of major governments. This encourages banks to load up on US Treasuries, Japanese JGBs, and Eurozone bonds. It assumes that the government can always print money to pay its debts, so a default is impossible. But default isn't the only risk. There's also interest rate risk. We saw this in 2022 and 2023. When inflation spiked, central banks raised interest rates. The value of those safe government bonds crashed. A 30-year U.S. Treasury bond lost nearly 50% of its value. Under the Basel rules, banks are often allowed to ignore these market losses if they classify the bonds as held to maturity. They can pretend the bond is still worth 100 cents on the dollar, even if the market says it's worth 60. This creates a fantasy balance sheet. It means that the capital ratios the banks report to the public, the numbers that say we are safe, are often a mirage. If the banks were forced to mark all their risk-free government bonds to the actual market price, many of them would be technically insolvent. The Basel rules, designed to ensure transparency, have institutionalized a lie. They allow the banking system to hide the fact that the government bond bubble has burst. The regulators are terrified to fix this because if they forced banks to recognize the losses, it would trigger the very panic they are trying to prevent. So everyone agrees to keep pretending. Furthermore, the Basel Accords are becoming a casualty of the new Cold War. The system was designed in an era of globalization, assuming that money is neutral. But after the sanctions on Russia in 2022, where the West weaponized the central bank reserves, the global consensus is fracturing. Countries like China and Russia view the Basel standards as tools of Western hegemony. They know that the rules favor the US dollar and US treasuries. As the BRICS nations build their own financial architecture, they are likely to diverge from the Basel standards. We are moving toward a splintered world, a Western bloc that follows the rigid, capital-heavy rules of Basel, and an Eastern bloc that plays by a different, state-directed set of rules. The dream of a single, unified global banking standard is dying in the hallways of the BIS. Ultimately, the Basel Accords represent the triumph of the technocrat over the banker. They are based on the belief that a committee of PhDs in Switzerland can calculate the perfect amount of capital for a bank in Ohio or Osaka. They believe that risk is a mathematical variable that can be solved. But history teaches us that risk is human. It is behavioral. It is unpredictable. By forcing all banks to look the same, act the same, and hold the same assets, Basel has created a monoculture of finance. It has stripped the judgment out of banking and replaced it with compliance. We have built a system that is incredibly robust against the last crisis, but incredibly fragile to the next one. The Tower of Basel stands tall, looking down on the world, confident in its formulas. But the ground beneath it, the shifting sands of geopolitics, inflation, and shadow banking, is moving faster than the architects can pour the concrete. The next time you hear a politician say, the banking system is strong, remember the tower. Remember that strong in the Basel dialect means stuffed with government debt. Remember that the lending has stopped. And remember that the rules are designed to protect the banks from you, not necessarily to protect you from the banks. We are living in a managed economy, guided by secret handshakes in a Swiss enclave where the primary goal is not prosperity, but the preservation of the status quo. The Basel Accords didn't fix the casino. They just ensured that the House and the government never loses. Serious, direct to camera. The Basel rules crushed the bank's ability to lend, which created a massive opening for a new player. There's a firm on Wall Street that is now bigger than the banks, more powerful than the Fed, and owns a piece of almost every company in the S&P 500. They are the true shadow bank of the world. I'm talking about BlackRock. In the next video, we are going inside the Aladdin computer system, the AI that secretly manages $20 trillion of the world's assets. Is it the ultimate risk manager? Or is it a weapon of mass financial destruction? You need to see this. Smash that like button to break the silence, and subscribe so you don't miss the BlackRock investigation. I'll see you inside the machine.